In this chapter, we'll be talking on managing your cash and savings. In fact, for most people, financial planning is just managing your cash and savings, which is not true. Because, as we saw earlier, that through the complete life cycle, your concerns keep changing. So, even your retirement planning, your investment planning, your insurance planning, your asset planning, your education planning for your children, your planning for your marriage, planning for your career, all essentially involves financial planning. What people believe on day-to-day basis, just managing your cash and savings is equivalent to financial planning, which is a very short-sighted, short-term approach. Now, when we talk of cash management, we talk of it is very important for financial planning process. No wonder that you need to be trained more in this area as compared to any other areas. Now, we'll be talking of today's financial services marketplace. We'll be talking of depository and non-depository financial institutions. We'll be talking of the checking, servicing, electronic banking, and other services that meet your day-to-day needs. And how do you open your bank account? How interests are calculated on your money using compound interest, future value techniques. Also develop a saving strategy that incorporates a variety of saving plans. Now, when we talk of cash management, we are talking of routine administration of cash and near cash resources. We are not talking of fixed assets. So, when what we are trying to deliver to you is establishing a saving program that is important parts of your personal financial planning. Okay, so what we know is that if we open a saving bank account, we typically get a return of 3 to 4% depending on different banks. Same way, if we put our income in certain FDs, we get 7 to 9% returns. Similarly, if we put in treasury, we get similar returns, slightly more than that. And if you have any kind of governmental bonds, you might end up getting about 7 to 8% or even more. So we have very low interest rates. The implication being that ultimately low interest rates, because of high inflation, they erode our purchasing power. They also discourage savings and reduction of finances that you can take from other sources. Also, it encourages investors to search for investments that pay greater returns or higher incomes. Like most of mutual funds are being sought out by Indians these days just because of lower bank interest. Now, you have certain financial products and financial services. When we talk of financial products, we are talking of bank accounts or check services, we are talking of credit cards, we are talking of loans and mortgages, we are talking of insurance, we are talking of mutual funds. Financial services entail financial planning, all your security broking services, your tax filing and planning services, your estate planning services, your trusts, and your retirement services. Now, when we talk of financial institutions, we are talking of certain commercial banks, we are talking of saving and loan banks, we are talking of credit unions, we are talking of other organizations, non-banking finance companies that accept deposit and give you returns. We have other services that offer banking services, but they do not accept deposits. So when we talk of different banks, we have different programs. We have insurance organizations, we have insurance companies in India. Now, when we talk of demand deposit, we normally talk of the account from which we can withdraw funds on demand. Okay. When we talk of time deposits, that means deposits are locked in for a longer period of time, and if you draw in short period of time, you end up getting lesser rate of interest. Okay. Then there are other negotiable instruments where you get interest, like you get interest on certain bonds, you get interest on certain treasury bonds, you get interest on certain corporate bonds. So you can have these for greater rate of interest. Then you have money market deposit accounts, then you have money market mutual funds, then you have other asset management account, other mutual funds. Then you have electronic fund transfer systems in India now. Funds are being transferred electronically. All banks have those facilities. Even now, insurance companies and other service providers have started. Mutual funds have started having the same kind of services. Most of us are familiar with debit cards, which are cool plastic cards with a chip. Please have a chip card rather than any other card. And you can use these to transfer funds from customer bank account to recipient account and also for withdrawals. Now you have ATMs where you have remote terminal, computer terminals where you get a lot of customer services and you can make basic transactions. Now a lot of services being offered by banks are today are pre-authorized deposits and payments. Banking by phone, online banking, bill payments, safe deposit boxes, and trust services. Electronic transfer services are being used very regularly these days, and under the law, no one can stop payment on a defective or a questionable purchase. So once you are very liable to have any kind of transaction fraud as far as the electronic fund transfers are concerned. And you have to be very cautious when you're using net banking or you're using your credit and debit cards. So when we talk of check account, there are a lot of people who maintain check account because of its convenience, services, and also it can be individual account or joint account. Also, you can write a check for greater account than your current account balance, which is called overdraft. And then what is important is that you have to keep on doing account reconciliation because you must understand what transactions you have made and what transactions have been there. Now, very little news are traveler checks these days and certified checks or cashless checks because now your ATMs are doing most of the purposes and your net banking is doing most of the purposes. So, but what is important for us here, why we have been talking all that is that it is very important for us to have a personal financial planning saving plan. A specific saving plan development is very necessary to accumulate funds. And also you have to consider risk preferences. That means which period you retain money in deposits and the levels of interest rates and levels of returns from different instruments. Then you have compounded interest or compound interest rate or simple interest rate. You have nominal interest rate, which is promised rate of interest paid on saving deposit or charged on a loan. Then you have effective rate of interest, which actually is a function of inflation and other things as well. So just understand that by compounding your money can increase very fast. Then you have certificate of deposits issued by a certain category of financial institutions, and then you have the governmental treasury bills. So these things are important for you to manage your personal investment, especially cash management in the short term. So you have cash management, are the certain terms involved, internet banking, money market mutual funds, and asset management accounts, you have demand deposits, time deposits, or ATMs, then checks, overdraft protection, I've stopped check facilities, account reconciliation, then you have time deposits, compounding interest rates, nominal interest rates and effective interest rates. Now these are certain terms that you have to understand. Why? Because cash management involves managing liquid assets, which can either be held in cash or can be easily converted to cash with little or no loss in value. Financial service industry is evolving very fast due to technological advances and changing regulations. Many of cash management products will also help you in comparing different cash products and services offered by various financial institutions. So cash management is a very important part of your total existence today and your financial planning in future. Thank you very much.